Following the Fed's decision to cut rates, the stock market is on a roll to the upside. Just take a look at the SPY hitting fresh all-time highs yesterday, cooling off a little bit here today, but still in just a monster upward trend that seems to not want to stop anytime soon. But maybe even more impressive is actually small cap stocks. Take a look at IWM just ripping to the heavens here on the idea that the Fed's gonna cut rates. And it actually makes quite a good bit of sense as to why small caps are running here on the rate cut rally. It's because the Russell 2000 is dominated by industrials, financials, and healthcare. All of these love rate cuts, especially financials and industrials. You can see that small cap stocks, or the IWM, the Russell 2000, has about 17 to 20% in industrials and a similar ratio to financials, and then healthcare, IT making a smaller section here than it does in the S&P 500, and of course the NASDAQ. And maybe one of the big reasons for why people are liking small caps and financial stocks is the rush to refinance. So a lot of homeowners have been waiting for lower interest rates to either sell their home, refinance their home, or their mortgage on their home. And of course, new home buyers have been waiting on the sidelines for interest rate cuts for some time. So there is a bit of a rush into the refinance stuff with rates coming down. The Fed's long-awaited rate cut could bring some consumer rates down, which may be good news for borrowers hoping to refinance into lower cost loans. And so should we be buying any sort of dip on home builders and home renovation companies like the Home Depot? Well, if you think about it, Home Depot stands to gain big from people making home purchases or updating their homes, renovating, etc. And so the market has already been sort of rushing in to buy Home Depot in recent times. And if you have watched my channel for a little while, then you know I made some money on Home Depot. I bought it during the April sell-off and actually closed out of it here recently. And while I do think in the short run the stock is a little bit pricey, if we were to get a sell-off and a pullback in combination with okay macro outlook, for example, falling inflation and growth metrics looking okay, on a macro perspective, I may actually look to get back into my Home Depot stock. Perhaps a pullback to about 405 or below could be of interest to me. But let's now take a look at the Home Builders ETF. This is of course stocks that, as the name might suggest, they build homes, right? So stocks and companies that build homes have been recently on a tear to the upside, pulling back here a little bit recently. And the question you have to ask yourself is, if you want to buy home builders, right? Rate cuts are coming, refinance, mortgage rates coming down, all those good things. The thing you have to ask yourself is the economy going to hold up and the labor market going to hold up well enough to continue to support the buying of homes even with lower mortgages, right? If people don't have jobs, it makes buying a home pretty hard. For this, I think it's a good idea that we reference the macro screener, which is a tool available within the stock box. The stock box, by the way, can be found linked in the description down below. Jobs data has not been super attractive here recently in the US. The non-farm payroll missed by 53,000 jobs from what was expected, just putting up 22,000 jobs in the prior month. ADP numbers were also much weaker than expected, and job openings continue to shrink. And this is largely why the Fed is cutting interest rates. So in my personal opinion, with stocks at very rich valuations currently, home builders and most high risk, high reward type stocks, I think could be weighted on for better dips. And I've been saying that for a while, and I know I sound like a broken record. And I've definitely been wrong in the sense that I haven't been sort of aggressively buying high risk stocks. But I still think the right thing for me to do based on my macro analysis here is that jobs data looks weak and the Fed is cutting interest rates, not necessarily just for fun, but because there's some risk to the jobs market. But going into the rate cut, of course, small caps were already a popular trade, and it still seems to be that way. Just take a look at some of our winners here today. You have companies like Fortinet. Here's Webull, which is absolutely going crazy here today. Palantir, we have Uber, right? So a lot of exciting names here going crazy. Here's Robinhood, of course, a stock that I own and love. We also have Oracle, which had that huge pop and still holding its gains. Tesla, which I have sold calls against my existing position. Here's an update on my Tesla trade. I own 400 shares of Tesla, and with the recent rally in the stock, I'm up quite a bit on my position. However, I have sold calls against my existing 400 shares that I own, and both calls are now in the money. What this means is that I am likely, if the stock continues to trade strongly, to be called away from my shares for a profit. Between all of my trades open, including the covered call position that I've sold or the call that I've sold, as well as the shares that I own, the account is up quite a bit on Tesla specifically. It's been my biggest stock holding for some time, and it does look like with the stock popping here, if we continue to see the stock move higher or stay where it currently is by the expiration date of October 17th, I will likely be taking a profit on the full trade and closing out for a rough profit, at least at the time of recording, around $57,500, which is crazy. $57,000 on a single trade is insane. Now, granted, I'm working on a larger capital basis, and there are also times where a stock goes completely against me. I'll show you 2 trades, like Fortinet, for example. Stock dropped big on me, and it was at one point was down about $10,000 for me. So I'm back still down, but only down about $4,800 now at the time of recording. Another stock that I have been completely wrong on was Lululemon, which has completely fallen apart, down 30% on my investment, or $7,000. And I have to say, with Lululemon, I'm actually trying to get out of the stock. This is not a stock that I am still interested in really staying with for the long term. So if we do get a bit of a pop to the upside, I'm going to probably close out my shares for a loss.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com, right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like edge finder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
One of the hot topics in markets recently have actually been precious metals. Take a look at gold here, as well as silver, making a huge push to the upside. And actually the GDX, which is the gold miners ETF, these are stocks. You can see this thing is going absolutely crazy. The miners are killing it. And I've been looking for a pullback opportunity on this one, just have not gotten it. We also have silver miners, right? So if you go SIL, you can see this one is off to the races here. Mining stocks really doing incredible stuff. You can see SIL is up 2.7%, while GDX today is up 4%. And you can kind of think of the gold miners and silver miners as a leveraged play to the actual spot price of metals. If you think that metals are really going to have a strong season, the miners can actually be a way to play it and gain additional upside with the additional risk that comes with them. Part of the reason for this, I think, is that oil prices remain low. So the cost to extract metals from the earth is still not so bad. If you get a big spike in oil prices, that can cut into the profitability of mining. And what has been and continues to be a very winning trade is the Semiconductors ETF, SMH. Semiconductors like Nvidia and Qualcomm and Intel all have been doing really, really well here recently, largely because of a deal that we heard between Nvidia and Intel. You can see here Nvidia and Intel to develop AI infrastructure and personal computing products. And you can think of Intel as a very hardware kind of manufacturing heavy component to the semiconductors world. And of course, Nvidia is creating the chips and the software behind things. Of course, they both do a bit of both things, but Nvidia is the prominent data center build out, semiconductors constructor, and Intel is involved in a lot of manufacturing. But there's criticisms here, with Yahoo Finance putting out this one that says Intel's biggest problem isn't going away with Nvidia's $5 billion stake. And yesterday was a huge win for Intel shareholders because the stock went up a whopping, let's get ready for it, 28% at 1.30% in a single day before pushing back lower here in today's trading session. And the thing here that's kind of drawing some skepticism, I think, is that you had this huge jump up, but nothing really has been formulated here. Yes, there is, the willingness to work together, but we haven't gotten many of the details between the partnership between these two companies, and yet the stock still exploded to the upside. I think part of the reason for this is that there's been a really negative sentiment around Intel over the longer term. Ever since it kind of lost its darling status in 2021, the stock has really gotten killed. So maybe the hope that it will be getting strung along with the current winner, Nvidia, has the stock popping pretty sharply. AMD initially traded lower in response to this news, but has since rebounded. And as a whole, like I mentioned, the semiconductor trade continues to be dominant. This huge push up, even from these lows that we saw in September, you're talking about a rally of 12+% in the Semiconductors ETF. And of course, we would be missing the full story if we weren't talking about Nvidia with this as well, which is still sort of chopping around at these levels. It hasn't really gone anywhere in the last few weeks, but we'll see if perhaps there is some upside breakout to continue this rally. But remember that the big thing with Nvidia is the concentration risk to just having a few customers provide the bulk majority of their revenues. Companies like Meta and Microsoft, who are buying in huge quantities these semiconductors that they're building, if anything were to change or disrupt that, and also the Chinese, right, purchasing, that's another big story as well. Any disruption to that could seriously crater the stock. So I personally chose to close out and take profits on my Nvidia shares. It hasn't really moved very much from when I sold the shares, but would be more interested in picking up the shares if we did get a pullback in the stock. And another stock that's been high up on the watch list for the top stocks algorithm within the stock box is UNH, UnitedHealth. And I've marked up this chart here for a possible pullback play. If we can get a move back down to the 38.2% retracement on UNH, I may be looking for a long position. UNH seems to have picked up momentum to the upside, and we still have some relatively good financial readings, like their trailing 12-month PE at 14.55 still looks good relative to 3-year average. Price to sales looks okay, revenue growth is still holding up, price to free cash flow looks good, and they offer a dividend. So UNH is probably a top setup for me if we were to get a little bit more downside in the stock to retest this area of past resistance that broke out here and could turn support. And if you're interested in getting access to the stock box, we are still running a significant discount on the tool for a limited time. You can find information by clicking the first link in the description down below to chat directly with a member of our support team. And if it's easier, you can just scan the QR code here, and that will connect you to a real person on our team who can answer some questions you might have about the stock box and any discounts that we are currently running. So scan the QR code, let them know you're watching today's video, and we'll get you access to the tool for a very low price. Energy stocks are moving down here today. Interestingly, the XLE ETF taking a little bit of a hit to the downside. Industrial stocks have been pretty choppy here recently, though I would think that if you are going to get sustainable rate cuts and a decent economic outlook, that the industrial sector could continue to push higher. Healthcare stocks have been sort of a boring sector to watch. We'll see if that can finally break to the upside out of this longer term range that we've been seeing. The semiconductors trade looks really strong, but also a little bit overdone in the short run. I'd potentially be interested if you did get a pullback here and the macro data looks a little bit better. And surprisingly, real estate stocks have not moved very much despite the exciting announcement of rate cuts. You can actually see that on that Wednesday when the Fed cut rates, there was a little bit of a pushback here. We've actually seen a rise in the US 10-year Treasury yield, which has caused a little bit of the air to be deflated out of the balloon, if you will, on some of the hype around rate cuts. Specifically, TLT bonds actually trading lower post-Fed meeting rate cut announcements. And despite the Fed's announcement of rate cuts, the 10-year yield, which of course tracks government bond yields, actually has started to bottom out in the short run. We also see a little bit of dollar strength coming back into the picture, and we're still seeing the dominant area seem to continue to be technology stocks. And when we look at our advanced decline chart or market breadth chart, what we can see is technology stocks have a large percentage of participation in upward movement in their stock prices, whereas things like industrials and consumer defensives and real estate, for example, are not seeing the same kinds of love. And let me just break down this chart a little bit further for you. What we're looking at is stocks that are above their 20-day moving average, their 50-day moving average, their 100-day moving average, and 200-day moving average. We've also broken this down for you by sector. And so what we can see is that high participation is taking place in technology and in financials, but some other sectors are not doing so hot, like consumer defensive. And if you're more of a momentum trader, you might favor going with the ones that are trending well. And if you're more of a value-centric person, you could potentially be shopping around in the consumer defensive area. And this chart can actually be useful for a multitude of different types of traders. And taking a look at our 52-week high and low breakout screener, you can see a lot of stocks are breaking to new highs, and not nearly as many are hitting new breakout lows. And as an investor, you kind of have to ask yourself, are you more the type of person that buys these types types of stocks, the ones that are hitting fresh lows, or are you more the type of trader or investor that trades the ones that are hitting fresh highs? For me personally, I think I lean a little bit more towards the momentum side of things from a trading perspective. And then from an investing standpoint, I do look for bargains, for longer term deals. And we've got to talk about Google because today is probably the last day that I will be owning shares of Google for a little while. I'll show you why. So I bought shares of Google at an average price of around $165.45. That's way back here, and it ended up being a really good buy for me. The only issue is that I then sold the 215 strike price calls that actually expire today. And so even though the stock price has risen beyond 215, I only have gains between where I bought the stock and where I sold a covered call. So I'm giving up some of the gains that we've had in Google. And I've talked about this recently in my videos. Why the heck would you even sell calls on your positions when this can happen to you, right? This is really frustrating where I'm giving up here. These calls have cost me $7,000 worth of gains on the stock. You can see that with the calls factored in, my overall open P&L is just $10,500, which is still great money, but I'm giving up a substantial amount of those gains because I sold these calls. Well, the reason is because we are currently living in a market that seems to go up every day, but that is not always how markets behave. And this is very much the good example of recency bias in markets. People have a tendency to believe that if the markets are going up, they're going to keep going up like this. And it's foolish to sell calls. With hindsight, of course, it does look silly that I sold these calls, but we can't trade looking in the rearview mirror. We have to trade looking through the windshield ahead. And while this was definitely a misstep, selling these calls was not the right decision, I still like the idea of sticking to my plan, sticking to my strategy, which is I do focus on the macro, and I am still a bit cautious on stocks. So I've sold calls against a lot of stocks that I own, and in this case, it is costing me because again, I have this call that I sold that is very much in the money, which as the seller is not a good thing. I own the shares though, so I'm not getting, killed on these by any means. It's just I'm forfeiting some of the upside gains. And so I will likely let this get called away and just take it. And what I mean by that is I'll let the shares get called away, which means that my call that I sold will get exercised by the buyer at expiration, meaning they get the right to buy the shares at 215 and I have to sell the shares at 215, even though it's trading at 254. This is not a fun one for me to talk about because it's not fun when you get called away from shares and you give up substantial amounts of the potential income and gains. But hey, this is trading and investing, and my channel, I'll always be as real as I can with you guys about what's going on in my account, both the goods and the bad. And if you enjoy my videos, make sure to hit the thumbs up button, subscribe, and remember to check out the stock box down below if you're interested in getting more information about it. Thanks for watching, and we'll see you in the next video.